Okay, welcome everybody. This is episode 108, and I very much appreciate you showing up. Got a good topic today. Anytime I get to talk about short volatility, it's going to be pretty fun for me. Volatility ETPs, it's kind of my thing. So today I'm going to try to illustrate the difference between short volatility and equities. A lot of people think these are largely the same thing. I'm going to try to show you that that's not actually true. And then another quick segment, I'm just going to illustrate the difference between two methods of calculating rate of return and why it actually does matter that investors understand that difference. And then, of course, we'll do the open Q&A. As always, you can start putting your questions in the chat now. I will get to all of those in just a few minutes. And then lastly, of course, as I always say, I don't run these with ads. I don't talk to sponsors. I'm not going to tell you about mattresses or, protein powders or anything like that. But the one thing that I do ask for, if everybody would give the video a like for me, that's actually very helpful. Subscribe if you haven't. It turns out about half the people that watch my live streams don't actually subscribe. And then, of course, share it with anybody you think might be interested in this type of content. But let's get into today's first segment. Okay, so why is short volatility actually different than the stock market? Like I said, a lot of people do think that they are basically a proxy for one another. When the stock market goes up, of course, short volatility also does well. When the stock market's crashing, that's when short volatility won't do well. They're basically the same thing, right? They're interchangeable with each other. Well, I'm actually going to show you that that's not entirely true. So first of all, for anybody who's new here, our main portfolio is 4 independent strategies. These have nothing to do with each other, so no decisions in this one are made because of what's going on in this one. All 25% allocations, but for anybody who wants to maybe simplify things a little bit, we also have what I call the absolute return portfolio, which is just 2 of the strategies. So maybe you don't want to trade options or you want to simplify your portfolio. Well, you can do that as well. But the main point here is that we have different strategies that focus on different asset classes. They use different volatility metrics to be getting these signals. And if you look at this strategy, this is tactical volatility, you'll notice that the position for our aggressive position, basically when the stock market is doing well, volatility is relatively low, we will be using the SVXY. This is an inverse, basically short volatility ETF. But then some of our other strategies, this one, for example, uses the NASDAQ index, which is just equities at leverage. And then this strategy, currently it's using Berkshire Hathaway. This is a very recent change. It might not stick, to be perfectly honest, but for many years, this strategy was using the S&P 500, the SPY ETF. And so we are using a mix of short volatility and equities. And one of the questions that comes up a lot is, well, why do you do that? Well, I mean, if they're both the same thing, if short volatility and stocks are the same thing, isn't this somewhat redundant to have different positions? And of course, my answer is no, and I want to actually show you why that is. So what I'm going to actually do is I'm going to try to illustrate where the short volatility trade performs best and compare that to where the stock market performs best. And you'll notice that they're actually different. Now, in order to do this, we have to be able to divide the market up in some meaningful way. Now, you could use the VIX index. That's a very basic, rudimentary metric. I don't really use the VIX for very much, but I just went one step further and I'm using what's called the adjusted M1, M2 VIX futures. This is essentially because you got to remember that volatility ETPs, they don't derive their price based on supply and demand. That means the number of people buying and selling them isn't actually what's driving its price. What's driving its price is what the VIX futures that volatility ETP is holding, what those VIX future values are actually doing, because these are moving around day to day. And that's actually what's causing the volatility ETPs to move around. So if you want a more detailed explanation, of course, you can go to my website, sign up for the free trial, just go to the subscribe tab. There's a 2-week free trial for everybody. You won't be charged for this, but when you arrive, you will see that there is a course library, and there's many courses that we have going. One of them that I want to draw attention to, though, is the volatility ETP landscape. This course, if you want to understand in much more detail what I just glossed over there about how these things actually work, you can go through the course. Currently, there's 8 lessons. There's going to be at least another 10 or 15 more, but 2 weeks is going to be plenty of time to get through this. And then, of course, what you do with the subscription after that is up to you. But like I said, go ahead and take this course and you'll really understand what volatility ETPs are all about. But we do have to use something to divide up the market. So I'm using the adjusted M1, M2 VIX futures. And the reason it's adjusted is pretty basic, but we basically have to adjust this because the VIX futures themselves, they can be a little bit deceiving based on how many days in the expiration cycle there are. Again, go through that 8-lesson course. They're short videos, 5 to 10 minutes. You'll understand this in an hour. But I have basically just done a further adjustment to make sure that we're taking into account the days to expiration. But the VIX futures is a very good way to divide the market up. I'm doing it in what's called quintiles, basically 20% segments, just showing. So the lowest range possible down about 23.79, highest value ever at 17. But we're going to be looking at how these things perform in those separate quintiles. So first we'll do the SVXY, and you don't have to know all of this stuff. We'll just get straight to the charts. But this is actually what it looks like for SVXY performance within those 20%. That says deciles. It should say quintiles. Sorry, typo. But you can see the yellow one stands out right away. This is 60 to 80% range. And then the next level is, of course, 80 to 100% range. So those are the high range. Essentially, what this would mean is high levels of VIX futures contango, meaning very stable markets. So this is probably not overly surprising for people to see that the best market for the short volatility trade is during the most stable market periods. But as you'll see, this is a rather important discovery. And then next, we're going to go to the S&P 500 and do the exact same thing. And again, on first glance, this might not mean a whole lot to people, but I'm just going to point something out really quickly. Again, the yellow's doing fine. This blue, the lighter blue, is doing fine. But I do want to point out something interesting, that the third best range happens to be the most extreme high volatility range. This is when the VIX futures are actually their lowest. I don't want to make this video too long, so I want to point you in the direction of another video I really do want you to watch. It's actually my most recent video. It's called Don't Buy the Dip Until You Watch This. This video breaks down why, when you're trying to buy the dip in the stock market, this is why buying the dip with equities works a whole lot better than it does with short volatility. Let's say the market crashes, volatility spikes to the moon, and you're going to be that person who wants to jump in, be the contrarian, and make a bunch of money when the stock market recovers. Well, you should always buy the dip with equities, and you should never buy the dip with short volatility. That will become clear in a second, but here we are looking at just the long-term buy and hold difference between the 0.5 leverage SVXY versus the S&P 500. And you can see long-term, actually the short volatility product does do a little bit better. Even though it's only half leverage, it is a little bit better. Drawdown is worse as well, but it is a slightly better performance. Now, it is also worth noting that the SVXY is a little bit leveraged compared to the S&P 500. So beta is a measure of how much one security moves in relation to another security. Anything over 1 means that the security moves more than the one you're measuring against. So SVXY moves more going up when it's doing well, and it also moves more when it's going down and the market is crashing. But let's break down those quintiles. Again, ignore that decile. I don't know why I said that. But this is the lowest range. So this is what you could call the highest volatility range. This is what we're looking at when the S&P 500 is crashing. Now, obviously, you're going to have massive drawdowns in this range because this is the worst time for the stock market. So you're definitely going to see the full brunt of the damage every time this happens. That's why with these rates of return, it's actually pretty close, 70 and 55. It's all going to show up mostly in this range. But you'll notice this is exactly why I say you cannot buy the dip with short volatility. Stocks do fine, actually. If you want to buy the dip and you really do want to be that person that times everything, well then go ahead and do that with stocks. It's not the end of the world. If the crash is over, then stocks are going to recover immediately. The problem with short volatility is that when the stock market recovers, of course, it immediately starts to go up again. Volatility products trade based on the VIX futures, and when that reversal in the market happens, the VIX futures are still going to be in massive backwardation. It's going to be a huge headwind for that SVXY ETF. So even though the market bounces, the SVXY does not. Not right away. It actually takes quite a while for this VIX futures to settle in to the next wave of what is to be a bull market, perhaps. So whenever you're talking about buying the dip, this chart is exactly why you use stocks and never short volatility. If we go to the next range, you can see things start to improve a little bit. From the 20 to 40% range, market is probably still a little bit ugly, a little bit uncertain, but the VIX futures aren't in super steep backwardation, so they can actually start to perform reasonably well if the market recovers. Now, technically, it's really just this big run up there after the COVID crash. That was a very, very fast, historically epic reversal in the market. Other than that, these would say I would probably about the same. In the 20 to 40% range, I would say overall SVXY and the SPY move about the same. If we go to the middle range, right, this is just dead average volatility range. We can see terminal results. The S&P 500 does significantly better. But I actually kind of want to gloss over this range today because I think this chart is something worth revisiting and coming back to. I think there's a lot of interesting things to unpack here, especially since from 2015 to 2020 is really where it's all happening. Other than that, the performance is kind of flat-ish, up a little bit for SVXY, but that 5-year period, it is worth revisiting. But for today's example, let's just talk about the bookends of very low volatility. Clearly, SVXY is not nearly as good. But now let's go to the 60 to 80% range. Now we can start to see that short volatility is significantly outperforming the stock market. Because now, presumably at this point, the VIX futures are very stable, they're upward sloping contango, everything is normal, we're catching a pretty decent trend in the market, and now you can see the advantage to being a short volatility trader, which should, in this range, do significantly better than stocks. Remember, even if the stock market stays completely flat and doesn't go anywhere, as long as the market is stable, short volatility can still make money. So all of those flat periods in the stock market, that doesn't mean short volatility has to stay flat. It's probably also making money during that period. And long term, the more stable the market is, the more outperformance we will start to see. So now we're looking at the 80 to 100% range. This is when you get a really long, stable trend. This would be when you've been in contango for, 40 or 50 days or longer. Everything is totally stable. Sentiment is good. Obviously, there's going to be some massive outperformance to be a short volatility trader here as well. So we can see basically my general point. During the most extreme volatility, when the markets are crashing, short volatility is going to perform way worse than the stock market. It's going to go down on down days even more than the stocks do. And when the market bounces, short volatility will not be able to bounce because of the shape of the VIX futures term structure at that time. It's going to be in backwardation. So this is going to be a downward sloping curve. And then, of course, the other bookend is during very stable volatility. You've clearly got something that's going to be performing better than the stock market. And then to bring it all back to my original point, this is why I trade both within the same portfolio. Short volatility with our tactical volatility strategy is not the same thing as the NASDAQ index or the S&P 500, or something like Berkshire Hathaway, which tracks the S&P very closely. These are not the same thing. It is definitely beneficial to have a full suite of strategies within your portfolio that are using multiple different asset classes. You might think it's easy enough, just do one of them, simplify the whole thing, but there are plenty of times when one of these three strategies or two of the three are doing much better than the third one. Short volatility is not just a proxy for the stock market. You don't just look at the market and say, well, they're both the same thing. I just feel like I'm going to short vol. No, you have to look at the environment that you're in and you have to choose the vehicle that is, of course, going to perform better because they're not always the same. If you understand the differences here, you can really improve your rate of return by not increasing the risk that you're actually taking on. So definitely understanding that markets move differently, different assets perform differently, and you really do need a full diversified portfolio to maximize your long-term rate of return. So now let's get into the second segment. Okay, so this is actually coming directly from a question that I got recently. Somebody emailed me. I think it's a good question. It's definitely a topic we need to talk about. So he says, for your absolute return portfolio, on the website, it says the return was 87%, but when I just add it up, it comes out to 68%. So if I go to the website, what he's talking about, if I go to the aggressive portfolio here, there is a video. You can check out the video explaining what this portfolio means. And then, of course, you can also see that it's just two of our strategies, and you can watch the videos for both of those. But going down to the performance section, it is here, and the monthly numbers are listed as well. And what he's talking about is here in 2023. I think he went through the numbers and just kind of added them up, and it doesn't actually come out to the 87% that is stated here. So essentially what we are getting at, there is actually a difference between how you can calculate rate of return. So the first method would be called an arithmetic average. This is just the sum of a series of values divided by the total number of values in the series. So basically, you just add up all the numbers and divide by how many numbers there are. Now, this would be appropriate if you were trying to determine the average of something where the results don't depend on each other. So let's say a classroom full of students. You wanted to know the average height of 30 students. Well, you would just add up the heights of all 30 of them and divide by 30. That would give you the average of the classroom. But the height of one student is not influenced by the height of the other student. So of course, you can just add them all up and divide by how many there are. That is not how investment results work, though. With investment results, we have to do something called geometric average. Now, mathematically, it's just calculated by taking the product of a series of values and raising it to the inverse of the length of the series. Now, that's kind of word salad there, so let's just take a basic example. This is the VTS absolute return portfolio results from the website, tactical and defensive at 50-50 each, and this is 2023. But if somebody's trying to calculate the annual return, they might be tempted to just kind of add them all up, and that's the number, right? 68.4. If you just take this minus this, plus all the way down, 68.4, nothing wrong with that as a rate of return, but that's not actually the 87 that I listed. But remember, investment results compound geometrically. The next month depends on where you're starting from the previous month, compounded over time, which means 10,000 makes this much, it goes to that value, and then this value makes this much and it goes to that value, etc., all the way down. And if you do that, compounded geometrically all the way down, it actually comes out to 87.28%. That's the stated rate of return for 2023. So you can see both of them technically using a method of calculating rate of return, but only one of them is using the method that actually depends on the previous month. This is also why losses are always so much more costly to a fund than the gains are beneficial. When we use the standard example of 50%, it's just the easiest math that there is. If you're an investor starting with $10,000 and you make 50% and then you lose 50%, if somebody's using the arithmetic method, well, they might be tempted to just say up 50, down 50, it's a wash, you're back to zero. But of course, investment results compound geometrically. So you've got $10,000 and now you're at 15 if you make 50%. And then if you lose 50%, well, now you drop down to 7,500. You go from 15,000 to 7,500. Remember, this number depends on the previous number. And of course, overall, you've lost 25%. And just for anybody who's going to be wondering, if you actually reverse the numbers and you lost 50% first and then you made 50% after, mathematically, this is the exact same thing. You're still down 25%. So when you're talking about investment results, it's not the same thing as the average height of a bunch of students. With investment results, presumably, I mean, of course, there is a way to say I'm only ever going to use the same dollar value and just not compound. People could do that if they wanted. But let's just say 99.9% of investors actually do compound forward. Well, at that point, you do actually have to use the geometric method. It's not nearly as simple. The formula looks fairly complicated compared to this one, but it is the only correct way to calculate performance. So that is essentially a very long way of me answering the question by saying, if you actually use the geometric method of calculating performance, then you're going to come out to that 87%. 68%, that's just if you add them all up. That's not actually what we do with investment results. So that actually carries down forward through all of our investing. Whenever you're doing your back testing, whenever you're doing your spreadsheets and all that stuff, you of course have to be sure that you're using the correct methods. Otherwise, your numbers could actually be way off. So just keep that in mind. Now, really quickly, again, like I said, I am my own video sponsor. You will not see other sponsors on my channel, but just give me 1 second here, and then we'll get right into the Q&A. So we'll get to the live Q&A in just a second here, but I launched VTS all the way back in January 2012 with 2 main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Now, our portfolio is currently 4 strategies with low correlation to the stock market and to each other, so it's a completely diversified total portfolio solution. It's also not active day trading, and trust me, anybody from any background can follow VTS in just a few minutes a day. day. Since retiring from pro golf in 2005, I've been an options and volatility trader for over 20 years now, and I share a lot of invaluable volatility data in every daily email to subscribers. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS on my website available to everybody. Come join members from over 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Okay, so I see there's a bunch of questions there. We'll go for about 40 minutes if I can try to cut it off at that time, and I think I should get through them all unless there's a new stream of a bunch. Now, the first question here, it's actually ordered incorrectly on my end, but I assume, see what it's listed for me, it says 3, 2, 1 in that order. But I'm just going to go ahead and assume that that's just my software showing weird stuff. So let's just assume this is the first question, and we'll get into this. You've got 4, so I'll try to get through all 4 of these and try to be quick here. How is it possible that I had a credit call spread position on the VIX? Okay, the VIX went down, the VVIX also went down, and yet the position lost money. So first of all, once you're in a position, the VVIX doesn't mean anything to this question. I'm not trying to say it's poorly worded. I'm just saying the VVIX itself might be helpful for you selecting which options you're actually going to trade, but the VVIX going up or down, of course, is irrelevant once you're actually in the trade. But okay, so my initial thought here is that you probably got yourself into trouble by not knowing the difference between the VIX price, the cash VIX, and the actual settlement for VIX options, which is the VIX futures. So let me just try to explain that. So when you're trading VIX options, there's the cash VIX term structure, or there's the cash VIX price, right? So we'll do it right now. What's the VIX at? It's at 1707. But when you are trading VIX options, and I know that it's a little bit misleading because it's called VIX options. If you want to actually trade options, you type in VIX, so people think that this is what they're trading. But what you're actually trading is what this settles to, which is the VIX future that is expiring on the strike for the expiration that you chose. So let's just say it's the first month. If it's something around the first month, the second month, the third month, there's different VIX expirations, but just to make this easy. But you can see the front month VIX future is actually 1835. This is going to happen in a more stable market. You're always going to see the VIX futures well above the VIX index. So this is actually what the VIX is going to be settling to, and it's not the same thing as the VIX. So in your case, for your question, I don't know what you were trading. You didn't give the full details here, but let's just say for the sake of argument, when the VIX index itself was at 1750, let's say you did an exactly at the money call credit spread at 1750. You could be in a situation where it's going to settle to the VIX futures that is not actually at 1750. So I'm going to assume that that's what happened to you. Typically, there could be $1 or $2 difference there. It could be even worse. And then the second thing that you might run into is even if you knew that and it was tracking sort of normally and your trade was looking really good right up until the end, another thing that trips people up is that the VIX settlement process itself is pretty weird. It actually Tuesday night, the third Tuesday of every month, it's not technically the third Tuesday, but it's almost always the third Tuesday. It's actually 30 days previous to the SPX expiration the next month, but nobody really goes through calendars and counts the dates. So just assume that VIX settles the third Wednesday of every month. But trading actually closes on the Tuesday night. You can't take any more trades, of course, but it doesn't settle until the first 30 minutes of Wednesday morning. And that difference can actually be significant. So let's say the VIX closes at 17. And then VIX settlement comes in. If the next morning the VIX flashes a really high price, like let's say it's just Wednesday happens to be a bad day, markets are down 2% or something like that, it could flash for that day and it could actually push the official VIX settlement up, 2 points. It can happen like that. So you could be in a situation where Tuesday night your trade was looking great. You think, oh, I'm going to make my full profit. And then actually the official settlement comes in and it turns out that it's a dollar or two higher and you actually lose money. So my guess, without too much information on the strikes you chose and the expirations, I would say it's probably a combination of both of those things. So just long story short, you want to always remember that when you're trading VIX options, you are trading and settling to the front month VIX future. And then also the last day of the settlement, the trade isn't over yet just because Tuesday night happens and you can't trade anymore. Remember that really weird settlement Wednesday morning process that, if you don't want to deal with it, or if your trade is razor close, if you're 50 cents within your profit range, sometimes it is best to just sacrifice that tiny little bit of final 30-minute theta, basically, and just go ahead and close your trade. At least you can lock it in and be reasonably sure that that's going to be the profit. If you wait and let it fully expire, you can bring in a few more cents, the final cents of that trade, but it's usually not worth it. So it's probably a combination of those. All right. Number 2, could you please explain the differences in the expiration and settlement process of VIX options? I think I just did, such as the role of VRO, not really relevant, and how it differs from regular options expiration. So I'm assuming that I just answered that. I should have read ahead to your things. That's the settlement process. The Tuesday night, final day of trading, Wednesday morning, whatever the VIX flashes. And sometimes people will accuse manipulation and all that because sometimes it looks a little bit weird. Sometimes, the VIX will flash high for the first 30 minutes and then it comes back down and everybody's like, oh, big money somewhere was just messing with the settlement process. Maybe, maybe not, but we're in charge of our own trades. So you have to deal with the market as it is, not anything else. So if you need to close your trade just because you want to be sure the price you settle at, go ahead and do that. Okay, I'm testing a trading strategy and encountered a scenario where, for example, I have 2 exit signals based on different IV percentile levels. Okay, I'm assuming this one's the next. One triggers at the 80th percentile and the other at the 50th. Let me read that again. I'm not understanding this. I'm trading a strategy, encountered a scenario. 2 exit signals based on different IV percentiles. How can you exit the same thing twice? One triggers at 80th and one triggers at the 50th. Each indicator performs well independently, but combining them actually reduces the strategy's overall performance. How do you norm? I don't see any other questions for you. So if a sentence got cut off and there's more to this, there isn't more on my end. I apologize for that. My software doesn't always show me all the questions for some crazy reason. I don't know why. I'm not understanding what you mean by you have 2 different exit signals. I'm envisioning a strategy that is somewhat binary, where you've got just a breakpoint, let's say going from the S&P 500 into bonds, for example. I'm not sure how you're going from 50th and the 80th with the same exit signal. So perhaps you're saying that you're sort of like me, where you have 3 assets, but then how do you combine them? Right? It's all the same strategy. You just, at the 50th percentile, you would exit stocks, you would enter something else, let's say bonds, and then at the 80th percentile, you would exit bonds and maybe go to long volatility or gold or something. So the way you worded it, and I'm, sometimes on live streams, you just read things wrong and your brain kind of freezes. Maybe this is just entirely on my end, but it doesn't really make sense how you could have 2 exit signals here. And especially doesn't make sense because the 50th and 80th percentile, you didn't say what your volatility metrics are, but I wouldn't care what the metric is. That is a massive difference. You would see an insanely different performance outcome by using the 50th to the 80th percentile. That's a huge gap. I mean, sometimes with quantitative trading, because things sort of happen on the margins, if you're talking about differences between the 77th or the 81st compared to the 83rd, sometimes you'll see it's not actually a smooth curve. You might have a really good back test at the 75. If you did the 77, it's really bad because maybe Volpocalypse happened at 76.99, right? And you just included it. But then if you filter that out and you went to 79, then maybe it would look better. You can get differences like that. But from 50 to 80, you're talking about an entirely different market. So apologies. I don't know. I'm going to punt on that 4th one. Okay. How do you stay productive? How do you plan your projects? Any specific app or tools? So, planning is a problem for me because I have so many plans and so many lists of things that I want to do and so many ideas. Honestly, I could manage VTS for another 30 years and not run out of ideas. So, um, planning for me requires removing things, not adding things. I have a problem focusing. I tend to go, down a path for a few weeks and then I get distracted and I go in a different direction. I really have to try to rein myself in and go in the same direction. I do have troubles with that. But as far as productivity, you know, productivity is the one of those things where you kind of have to force it for a few years. For the first few years of whatever you're doing, you can just brute force with discipline. I mean, discipline always is better than motivation, but discipline really gets you through the first few years. But after that, you really have to find ways to make yourself productive. It's not always going to be as easy as the first couple years. So things that I do, one thing that really helps is to actively try to make whatever job you're doing more dynamic and much more diversified across different tasks. So for me personally, at the end of the day, I am just a trader. Like this whole thing is just my portfolio, my live capital. So I'm constantly learning every day. I'm studying every day. I'm working on my trading every day. And so I can be very productive for, say, 2 or 3 hours straight on that. I just get a coffee and I just work for 2 or 3 hours. And then switching gears to maybe some administrative stuff within managing the business. I can do that for a couple hours. And then I can switch gears and I can do some video work and I can write some scripts. And then when that gets boring after a couple hours, I can switch over and I can write a new article for something or work on the options course. I've actively made it so my job is I've got 6 or 7 completely different tasks. And so anytime I sort of feel like, you know, it's 10 or 11 in the morning. I've been answering emails for 3 hours. I'm sick of this. I don't want to do it anymore. I don't close the computer and just do nothing. I've got 6 other things that I still have to do that day, and I just switch gears into something else. So it seems like you're productive for 12 straight hours, but I've actually done 6 completely different tasks for 2 hours each, and it's actually easier that way. So that's what I would say. If you have a really mundane job, it's going to be a problem because after a couple of years, you're going to run out of motivation, and you're just going to be stuck with just going through the terrible mundane tasks. That's not good. So hopefully you've got something where you can add some video work, maybe some sales calls, maybe some email work. You get the point. That's really going to help you a lot. At the end of the day, yeah, you have to force it because nobody, you've always heard, well, if you love your job, you'll never work a day in your life. There's nothing that you're ever going to love once it becomes your job to the point where it doesn't feel like work, right? Even for me personally, as a golfer, I was a professional golfer. I loved golf for the first 10 years. It was just my passion. I could practice all day, every day, no problem at all. But at some point, it turns into a job and you think, well, at that point, you kind of lose the passion a little bit. And it happens with everything. I can honestly say that I loved managing VTS probably more in the past than I do now, right? When I first made my first 10 videos, it was super exciting. It's kind of just standard now. So you're never going to love something so much. So you really have to just force yourself into a situation where you're going to have to find a way to be productive for 10 hours a day, and nobody can do the same task for 10 hours a day for 10 years straight. So, yeah, do 5 different tasks for 2 hours. That's way easier. My unsolicited 2 cents. Trading risks are skewed and percentiles are not the best cutoff thresholds. I assume that is an attempt to answer this question. I'm sorry. I might have just misunderstood what you were asking, so I kind of punted on that one. All right. How does Vanna and charm come into play when shorting volatility? Uh-oh. How and where does the volatility effect of Vanna come from when shorting volatility? So I'm not going to get into the weeds with this. Like, nobody here understands really what you're asking. It just gets into something that you don't need to know this for option trading. The thing that I always tell people is Basically delta, theta, and vega. Understand what those are. And you don't even have to learn how to calculate them. You just have to understand what they are. But you don't have to know Vanna and all these things. Like okay, so gamma is the rate of change of delta with respect to the price. And we occasionally will use this, right? Even for that one, when I'm teaching options, I basically ignore gamma as well. And then charm would be the kind of the same thing, rate of change of delta with respect to theta with time, and then Vanna with respect to volatility. So these are second order Greeks that you really don't have to understand what's going on there. It's not going to come into play. I mean, I don't know. There can be times, I suppose, where you might take a peek at something like that, but no, just you don't have to do the second order Greeks. Even gamma, you can throw that one out. Just understand delta, theta, and vega, and you should be fine. It's possible at some point I might go into some videos when I do the option course to just do like a 5-minute video on each of them and make it clear in the video that, look, you'll never have to look at this again, but here's a 5-minute video on, D vega, D time, and all these stupid things that you'll never have to look at. Yeah, there's like 12 Greeks, but 3 of them matter. Ignore the rest. I saw a video online that uses this strategy. When VIX is less than 18, open 120 days SPY straddle, short, I assume. Then sell weekly strangles with the range of 1.5 to 2 times the expected move. Can you talk? So I suppose what you're trying to capitalize on here is the fact that, no, you'd probably want to do the long straddle and then shorting the weekly strangles. I suppose you're trying to capitalize on the fact that presumably over shorter periods of time, 1.5 to 2 weeks, something like that, weekly strangles, you say, that the VIX is going to be somewhat range bound, but you've got that longer dated straddle. So for that, kind of anything goes. And then you're basically just going to be trying to track the VIX around in a 2-point spread weekly. I see nothing inherently wrong with this, but there's going to be an awful lot of weeks where it doesn't work out, right? And then you've also got the main issue that I talk about a lot with respect to volatility ETPs. A lot of times people make this mistake, is anytime you're allocating capital to something, you have to make sure that that's the most efficient place to put capital. We're not actually trading, and I have to be careful how I word this. Sometimes people think I'm saying something that makes no sense, but when you're trading, you're not actually trying to just make money. You don't look at the position and say, I'm going to do this strategy and it's going to be profitable and therefore it's worthwhile. It's not about whether something can make money. And this can make money. It's about whether it's making the most amount of money given the capital that you are allocating in a universe where there's 1,000 other choices. So a couple of examples that come up a lot is pairs trading. When let's say you're shorting 2 triple leveraged ETFs against each other. I'm not saying that won't work. I mean, sure, if you do the timing correctly, it's fine. But you're tying up capital with something where it's going to make a small rate of return. So it's probably not worth it. Another thing that people do, and I was getting to this, is they hedge with the same product that their bulk of the profit trade is also trading. So maybe they are going to short volatility, but they're going to hedge it with VXX calls or something. Well, when you're short a volatility ETF, like say you buy the SVIX and then you hedge it with VXX, the same thing. They're the exact same, materially identical products. You should just do a smaller trade and not hedge it, right? That would be like buying Apple and then shorting Apple shares as well as your hedge. So in your case like this, I'm assuming you mean a long straddle with short weekly strangles. You are hedging with basically the same instrument that you're buying. So your profit's going to be much lower. So then you have to make sure, I'm not saying this wouldn't make money, but you have to make sure that this is going to make more money than anywhere else you could put your capital. And whenever I see these things where you're doing one thing and then you're pairing it against something else, oftentimes they're lower rate of return strategies. So probably the risk is much lower because you're hedging with the same thing that your underlying is trying to capitalize from. So it can't get too far out of hand, of course. You've got that straddle in place. but the profit is probably not worth the massive amount of capital that you're going to be dumping into this. So it's the same thing with pairs trading. Not saying it won't work. It's just not as good. It's the same thing with selling naked calls on UVXY. I'm not saying you can't make money, and I'm not saying you can't manage the risk. Maybe you can, but it's unbelievably capital inefficient. It costs a fortune to just short one call, right? So you can do a lot of better things with your capital. I suspect that would be my answer. If you gave me more details, I suspect my answer would be, I think I can find better places to allocate capital. But not saying that that's not good and it wouldn't make money. It probably could. Hopefully that made some sense. It's about capital efficiency. Like I said, it sounds funny to say it, but we're not actually just determining whether it would make money or lose money. That's not enough. It has to make the most amount of money with the least amount of capital allocated. That's when your portfolio is going to grow. All right. Just finished reading Safe Haven by Mark Spitznagel. I've heard that name before. He's a big on arithmetic versus geometric. I don't know what that means. Big on it. Instead of rotating to safety, he appears to rotate in and out of arithmetically cost-effective puts. I get the puts part. I don't get the arithmetically cost-effective puts part. I don't know what that would mean, as opposed to geometrically puts. I don't get that. I get what you're saying. Instead of rotating to safety, he just layers hedging. It can be done, but hedging's very expensive, right? By very nature, hedges are most of the time going to expire worthless. And so what ends up happening with people who try to hedge things rather than just rotating out completely like I do is that you spend so much money, you burn so much capital on the hedges over time that when that day comes and you finally need your hedges, yes, it saves you in that specific moment, but it's not worth it. You actually lost more money in the accumulation of losses with the hedges over years than you did in the one or two instances where it actually paid off. This is kind of why I trash talk the hedging component of something like SVOL, for example. When you're talking about short volatility, you cannot buy and hold no matter what, full stop. SVOL is going to get crushed when the market crashes. Hedging it doesn't matter. All you're really doing is saving a small amount of losses when the market crashes, and you're spending capital every single week like clockwork for years, and your rate of return is just way lower. So I prefer to rotate into safety, but there are certain people, certain asset managers, for example, that perhaps you're managing a very large book and you've got a bunch of clients and it's just simply not feasible to rotate people out of everything, twice a month. Then if hedging is your only choice, okay, you got to find ways to do it efficiently. I don't know what arithmetically cost effective means. I know hedging is not my style, but it tends to be the default for most people. It's just too expensive, and it should make sense when people think about it that how could you hedge a trade so effectively that it won't go badly in a crisis and still have money left over to profit from it in good times? It doesn't really work that way. You can either not hedge at all, you make way more money 90% of the time, and then you get killed on the 10%, or you can hedge really heavy and you don't make any money during good times because you've hedged so much, but then you also might not lose very much money in the crash. But you can never really balance that. It's a cost out no matter what. It's always going to be more expensive. It reduces your rate of return. So I prefer to manage my drawdowns with full exit to different asset classes rather than just lighting money on fire, hedging money on fire. All right, I'm a new subscriber to VTS. Welcome. Your work's so impressive. Thank you. Appreciate that. I have a question about the calculation of cash VIX oscillator. I only see the introduction about the short long-term VIX crossover in the article. Yeah, Daniel, unfortunately, a few of the volatility metrics that you will see in my daily email are sort of proprietary. They are internal only. So I will never show people how I calculate the volatility barometer. It is arguably the centerpiece of my work. Cash VIX oscillator is a metric that I created that I think is probably the second best option if somebody didn't, for some reason, have access to this. But that is also I just don't want to share how I calculate that because it's really unique. And honestly, you could Google all day long and you won't find anybody else talking about that. So I do feel like it's pretty special in that regard. Unfortunately, some things you got to keep to yourself, keep proprietary, and that is one of them. So it's listed for you. If you want a list of all the previous values, email me and I'll send you that. But as far as how to actually calculate it, that's my secret sauce. All right. What was the 80%-ish CAGR portfolio? I don't understand that. Sorry. Sometimes it's hard to keep track of the order because I'm doing a presentation first. And sometimes when I'm doing the initial 20-minute presentation of whatever topic, my eyes sort of glance over at the comment section and I can see comments coming in. Sometimes it trips me up a little bit because I want to stop what I'm doing and go ahead and answer the questions. But you probably asked this at a very specific moment or to somebody else that I'm not following the conversation. All right, as for the aggressive portfolio, can I use strategic tail risk plus tactical volatility instead of using defensive rotation plus tactical volatility? Yeah, you can if you want. But the whole point of the aggressive portfolio is that it's aggressive. We have 4 strategies right now. We've got tactical, defensive, strategic, and iron condors. And there's no question that tactical volatility and defensive rotation have the highest rate of return. Of the 4, those are the 2 best performers. They also have the 2 highest drawdowns, keep that in mind, but they are the 2 top performers. And I have been accused in the past of being too conservative by some people. Some people I always tell people, if 15%, 20% a year isn't enough for you, that's probably a you problem. You probably have a spending problem. You have a lack of income problem. It's not going to be solved by, rolling the dice and taking on massive investment risk. But look, if I'm not going to tell you what to do with your money, if you want to be more aggressive and you want to go into the mid 20s or up to the 30% range and you're fine with 30 or 40% drawdowns, then that's why I presented that other portfolio. I guess it would depend on how a person looked at it, what you're valuing. But I mean, technically speaking, it's better. The return is better. But you have to understand that there's only one negative year, but it was at the lows this year, the defensive rotation was down 40.2%, and tactical would have been down about 35%. And so, yeah, if you can sustain that and you're fine with it, which again, I have to be fair, I always kind of use the 1.5 rule that if you've got a very long track record to look at, oftentimes people just look at where it starts and where it ends and they just assume that they'd have the risk tolerance to sustain it. I would remind you that it's possible that you don't. I had subscribers because, of course, every month I get new subscribers. I also have people that fall off every month, but it's been a net positive for the 13 and a half years I've been going. But you have to understand that there's new people every month coming in. So if a new person comes in and the performance is good for 6 months, they think I'm a genius. They watch my videos, they watch the live streams, they think, oh my God, I can't believe I didn't find this 10 years ago. But you have to understand that there's, just by the nature of the fact that there's new people every month, there's also going to be people that join at the exact wrong time. And they think I'm a complete fraud and a liar and a scammer, right? So you can imagine we had a situation, I can actually illustrate this, where a person joined, many people joined, probably 10 to 20 new people a month, let's just say. Actually, many months, it's more than that. But let's say a person joined right here. They joined in, say, September 2021, which some people did. Well, this person joins and they're going to be down, at the bottom in the high 30s% drawdown. And they're going to think I'm a fraud and a scammer. So do you have the risk tolerance to sustain that? And then what I also like to do is tell people, go ahead and use a 1.5 rule as well. Just assume that whatever the maximum drawdown was, if it's a long track record, assume it could be 1.5 times that. So assume that it's possible in some universe it could get to 50. If it's a short track record, you should assume it could get double or more, right? If you're only looking at a 2-year track record, that means almost nothing. So just assume that whatever drawdown they're talking about, it could get at least 2 or 3 times that. But if it's a long, like I've been doing VTS forever, right? We've been doing this since January 2012. It's long enough to have an idea of what you're going to be expecting when you join. But you have to understand that there's people joining the entire time. So the people that joined right there think I'm an absolute genius. The people that think I joined there are going to be telling everybody on social media I'm a scammer and a fraud. The people who joined here are going to be happy. The people who joined here, they immediately got hit with a 15% drawdown. You get the point. People who joined here were in a drawdown now. It's just is what it is. It's the nature of investing. There's always going to be tops and bottoms to everything. So could you do the defensive and the tactical and strategic? Getting back to your question, you could, but that defeats the purpose of what I prepared. And then what I would say is, why not just do the full, sorry, I got ahead of myself. Why not just do the portfolio that I have presented, right? Just do the 4 strategies. Because once you include strategic, now you are including one of the lower returning strategies, something in the high teens, for example. Just do the full portfolio at that point. That aggressive portfolio is only for people who think I'm too conservative. And look, there's people who can buy and hold Bitcoin. So I'm definitely more conservative than a lot of investors out there. Yeah, that defeats the purpose. I would say if you can handle a 40% drawdown and you're sure you can handle it, then go ahead and trade the aggressive. It will most likely be better than the absolute. But not everybody has risk. They think they do. Everybody thinks they have high risk tolerance. And then they find out in a crisis that they don't. So be careful. Okay. Given that in 2022, muted signals and safety assets failed to provide sufficient portfolio protection during the slow grind down, correct assessment, and with anticipated economic headwinds for Q3 and Q4, I agree so far, what specific changes, if any, have you implemented in the VTS system to better safeguard the portfolio against another prolonged gradual market decline? So good question. I've touched on this a lot. This gets to the point of, there's 2 things you're touching on here that are important. The first one is, should you optimize a portfolio for something that only happened once, right? The situation that happened in 2022 only happened once. I demonstrated that if you look at a 50, 30, 20 portfolio of stocks, bonds, and gold, not only was it worse than 2008, but it was way worse. It was like double digits worse, not even close. You look at them all on a chart for 30 years, and then a massive outlier for 2022. It's not like it was just slightly kind of in the ballpark. It was just apocalyptic as far as a diversified portfolio. So it's only happened once. Should you optimize a portfolio for something that only happened once? I would say no. So any major changes? No, I'm not going to make major changes because I think maybe 2022 happens again. Second thing that you're getting at here is predicting the future. You got to be careful with that, because are you honestly saying that you cannot envision a scenario where the United States avoids recession and people do just get excited about the eventual deregulation and the headwinds or the tailwinds that will naturally appear? I mean, the tariff stuff, if it maintained at full speed and it really did, like Trump's initial plan for tariffs, it would have been the most devastating economic event that the market has ever seen. Honestly, I'm not exaggerating. It probably would have wiped 5 to 10% of GDP, like that bad. But a lot of that is probably just going to be phased out and forgotten. Honestly, I think they're just going to kind of drop that and just walk the other way, because I think they know what that would do to the market. I think that a lot of this was, I hate getting political, but a lot of this was Trump just being different for different sake, right? A lot of the things that if you sat Trump down and you asked him some direct questions and you caught him on a good day where he's actually going to give you real answers, if you asked him some things, he would actually agree with some of the things that Biden did, right? I don't think he would blank out the CHIPS Act, for example. I think that if you didn't say that this was Biden's bill, if you just said, hey, do you think it's a good idea to, list the top 3 things from the CHIPS Act, Trump would absolutely say, oh, that sounds great. That's exactly what I believe. Yeah, you should absolutely protect, the chips industry and local, production and all that. He'd think it's great. But because it's Biden's, he just blanks it, right? So Trump gets into office and he basically just goes the other way. And I personally think just for volatility's sake, I do think that, look, this is a pretty big accusation. I don't mean to offend anybody who is a Republican or voted for Trump, but I do think that there was a lot of insider trading and a lot of market manipulation for the purpose of making the cool kids in the administration a whole bunch of money. Like the tech bros basically said, we will get you the presidency, but on the other side of this, we're going to need a little bit of, finessing of the regulations. We're going to need the Consumer Protection Bureau defunded. We're going to need all these things done. And because of that, I think it was sort of a feature at that time. It was like a 3-month period where, there's no doubt that they were making billions of dollars. But I do think that when you get into the business of saying, well, here's what's going to happen in Q3 and Q4, and so therefore I'm going to change my portfolio, I mean, good luck with that. That's certainly not my style. I'm not one to tell you you're wrong and I'm right and mine's the only way to invest. There's lots of ways to make money. Mine's only one. But I personally just can't get behind, A, making changes to optimize for something that happened once, bad idea, and B, saying I know what's going to happen in Q4, therefore I'm going to do all these things. I don't know what's going to happen in Q4. For all I know, the S&P is at 6,500 by then. It could happen. Can you honestly envision a scenario? Yes, right? Hopefully the answer is yes, unless we're looking at a totally different market. I could see a recession, absolutely. I could also see stocks at all-time highs. And the third thing is I could also see stocks crashing and bonds and gold actually doing well. That's the difference. That's why 2022 sucked, is that my utilities was bad. My real estate was bad. My gold was bad. All of the safety positions were bad. I don't think that's going to happen again. Knock wood. I'm not going to make any changes. I just think that that's a poor way to invest long term. I'm in this, like I'm old. I'm old and washed, as I always say, but I'm not that old. I still have 20 more years of investing ahead of me. I have to make the best decisions I can for a 30-year block of time. I can't be saying here, I know what's going to happen in Q4 because of Trump's going to do this. Trump doesn't know what he's going to do tomorrow. How do we know what he's going to do? It's just, let's just put the best portfolio forward and do the best we can. And hopefully he doesn't run it off a cliff just to make his friends money. Hopefully he doesn't do that. Hopefully he's made enough money at this point. The meme coin made him billions. The insider trading on we're going to do tariffs and then we're not going to do tariffs made $1 billion more, and all his friends made billions. They were joking in the White House. He made $1 billion and he made $400 million. Hopefully it's enough for them all. And now they can kind of just say, okay, well, let's maybe do some governance, Hopefully we're at that point. So apologies if it's too political. I don't mean to be. I hate the Democrats probably more, as if you follow me long term, probably more, but doesn't mean the Republicans are all good. There's shenanigans going on all sides. They're all in it for themselves. So let's just be greedy and make the most amount of money that we can. That's my advice to everybody. Okay, this came from an options video on YouTube, and I also just found it confusing. They seem to promote STH, but don't clarify the risks. I just want to understand it I'm sure I missed something. That seems like it's mid-sentence. Okay. Yeah, I answered this already. Okay. So then the follow-up to that straddle, strangle, long-dated versus short-dated question is this. Came from an options video on YouTube. Vet the source, right? Of course, I'm on YouTube too, so vet me as well. But what I mean by vet the source is a lot of people on YouTube are just making YouTube videos to get clicks, right? This is not something that they're probably even trading for longer than a week. I'm not making any accusations in this case, but I'd say 90% of YouTube finance videos are people who are not investors. They're YouTubers, right? They're people who understand the algorithm. They're people who are creative. They're people who are good on camera. They're people who make great thumbnails and make great videos, but they're not investors, right? There's a big, big difference between somebody who's an actual investor and somebody who's a great YouTuber. Massive, massive difference. So if it's just from a video on YouTube and you're not also thinking this is incredible when you watch 20 other videos and there's no contradictions and you're thinking, okay, I can tell this is a person who's been doing this for 20 years and it's all good. If it's not that and it's just some random video, then I would say, gloss over it. But the other problem that I would say, and this is super big problem on Twitter as well, is the half information is worse than no information. If they give you a YouTube video that tells you how to do this strategy, but they are obviously going to be withholding the true details and the long-term outcomes and the full risk management plan and all the position sizing, and they're showing the results along the way, only giving half information is going to land you in a far worse place. This is what bothers me about the Twitter traders who always say, I post everything on Twitter. I post all my results on Twitter. I post all my trades. I'm the most transparent person. No, you're not. You're just saying I bought a UVXY vertical. What position sizing? What percent of your portfolio? What was your risk management plan? What was the time frame? Like, there's no information in that. You're just saying, here's what I did. That's not useful to anybody but yourself, and it's not even useful to yourself. So yeah, don't fall victim to the half information stuff. You need the full picture, or it's just a random tweet, right? But yeah, I think I got into it that without the full details, I would say something like this sounds like it would work just fine. I have something similar that I call the calendar roll, where I'm essentially doing something similar, where I'm a calendar buying a long dated option and then selling a bunch of shorter dated options against that longer dated option. And hopefully at the end of it, you've made far more on the shorts than you did on the long. It's kind of the same thing that he's talking about. But the thing you have to understand is that this by its very nature is going to be a lower returning strategy. So it does come back to what I said. It's all about how much capital it actually costs to do this. If it's very capital efficient, like a calendar, for example, is, then yeah, I can find a place in my portfolio for it. But if it's something that's going to be capital inefficient and it actually costs a lot to open these positions, then no, it's absolutely not going to be worth it. The details, and I tried to get to that, hopefully I gave you a decent answer, is that it all comes down to the capital efficiency. There's nothing wrong with the strategy. I fully endorse the idea of picking up premiums against a long as the long-term hedge. But capital efficiency is a massive gap, and it's something people don't talk about. It's something most people don't consider. It's something that all the naked option sellers don't consider, is that the moment you turn something into a naked option, I can probably find you 10 other strategies that are far more efficient and just make more money. It's not that it won't make money. It's not that selling naked calls on volatility ETPs won't be profitable. It will. But there's no chance that it will be more profitable than defined risk options. No chance. So that's the point. Make it super efficient, and then great. Like a calendar is almost by structural design going to be very capital efficient. A butterfly, for example, very capital efficient. What you're talking about, straddles versus strangles when it's not the same trade, a few flags are going off. I have a problem with that efficiency. I wasn't trying to suggest I have any predictive powers. Sorry, did I come down too hard on you? I went on a whole Trump rant for your question that had nothing to do with Trump. However, history tends to repeat itself. In the early 1930s, when tariffs were first introduced, the market ground down for 2 years and then took until the early 50s to return. That's true. I mean, if you look at it from like 1929, when the stock market crashed and it went down to the original drawdown, it took until 1955 to recover that drawdown. So it was in a drawdown for 25 years. Yeah, so you're right there. I was wondering if you ever consider alternatives if we find ourselves in that situation. Well, I'm not saying there has been no changes since 2022. There's been a few. Let me highlight a couple of them. So the number one change is this cash position in defensive rotation is expanded. This is actually a full 10% now. So I am assuming that there's going to be mostly in cash, whereas if you went back to the defensive in 2020, there was no cash. right? It was just utilities. That change that I made, when did I do that? I'm going to say sort of mid 2022, maybe. I don't know. I'd have to go back in my records. But this cash position is going to help a lot. Changes here. This used to be long volatility, and now it's the chaos ETF. I think I'm really excited about this, to be honest. I can't wait for the next market crash. I'm getting my popcorn ready. I can't wait. But we don't get to test it very often, but I just love this. Nothing wrong with long volatility, but we already do long volatility and tactical. So I'm super excited about this change. The IYR to TLT change, you can't see it here, but we will be using the Coca-Cola, the Coke. We're using the Coke stock if interest rates are rising. That's a small change that I made that we have not had a chance to implement yet because the Fed is not in a rate rising cycle. But that's going to be a positive change. And yeah, that's about it. Just small changes. But like I said, it's very unlikely that 2022 will repeat because gold and bonds will probably do much better the next time around. That is me making a prediction. I mean, technically speaking. But what I'm saying is what happened in 2022 was a very strange environment that I don't anticipate the safety positions failing that badly again. I think it was just odd. And it's worth betting that it's odd because in a 100-year cycle, it's probably only happened once. So I think it's worth betting that. SHT. Sorry. Is this like young, cool kid slang? I don't know. I'm old. Everything like that's going to go over my head. New question. Okay. New question. With respect to, see, I got one of those. Don't do the abbreviations though, because I'm going to miss most of them. With respect to drawdowns, why not make your prior 6 to 12 months of daily emails available for download or online so people can independently backtest using your suggested trades? I had another. Oh, wait. No, this is the same person. Yeah. Sorry about that. Sometimes the names don't match up. I read your email just before, maybe an hour before I went live, and you said like second update. I have no problem making the emails if it's easy, right? I think that you are the only person who wants that. So it's not something that don't think that there's going to be a bunch of people who are like, oh, this is an awesome resource. I can go back and read his emails from 6 months ago. You're not going to read those emails. Essentially, how I function is anything meaningful from my blogs along the way. Obviously, the videos go up on YouTube. The live streams go up on YouTube. And all of the articles, like, again, people think I'm just video only, but I write a lot. There's tons of articles. Like this is just since April 17th. There's a bunch here. Anything that I think, oh, that's an extended article that somebody might want to come back to if it's in the daily blog. Like some days, this is today, I just gave the link for the live stream, and then I gave a little YouTube short, like a 60-second short on Delta. So nothing there is going to go up. But if it's interesting, it's already on the website. All the articles, videos, and live streams are up there. So essentially what you're talking about is just the trade signals, which I don't have a problem just sending you that. My issue with this is weird because we're just like one guy talking to one guy and everybody's like, what is he talking about? So he gave me this method where I can actually dig up the old emails from Gmail. Like they're still there apparently. I'm super tech illiterate, so I don't know this stuff. But apparently they're all still there somewhere. So I can revive them and then make them all available. Again, not one person is going to actually go do that. The only useful things from old emails are the articles, videos, and live streams. And all of those are already publicly available for free for everybody. So if you're just talking about the trade signals, just ask for that. I don't like to deny requests from people, but it does strike me as a pretty useless resource to put on the website, like past emails. Nobody's going to go back and read my email from April 17th. Because if it was interesting at all, go on my website, look for April 17th, and the article is already there. I just literally copy and paste and drag it. So, I mean, if you want the old things, I'll just send you that. It's just, on my end, it's just so much easier. So if you really want to wait, if you really, really need this, then give me some time. Because of course I've mentioned it before, but this Friday I'm actually taking my wife to France. It's our anniversary. We're going for 2 weeks. I'm going to be drunk most of the time. We're going to the Champagne region, and then we're going to Reims, we're going to Epernay, and then we're going to Paris. So I can envision a scenario, my friend, where your request gets bumped a few times. But you could save me an awful lot of time if you would accept just the trade signals. Super articulate as always, not related, but how do you train to become so well-spoken? Wow, that's a compliment. I don't think I am at all. I don't even notice it. Not glazing. Just want to improve in my speech as well. Well, presuming that I am, which is a big presumption on my end because I am just talking here, but if we're going under the assumption that I am articulate and speak well on camera, I think that's the key. I think that I've talked about this a lot, but I'm an extremely nervous public speaker. When I was a professional golfer, by the time I got to pro golf, I was actually decent. But in amateur golf, and especially junior golf, I mean, it was a nightmare. I started golf very late in my career. I started when I was 15, which that's very, very late for pro golfers. Most people start when they're like 3 years old. But I started when I was 15. I couldn't break 100. By the time I was 16, I was winning tournaments. And then I went on to be a professional. But for the first 3 or 4 years, I am such a nervous public speaker that I literally intentionally lost tournaments so I wouldn't have to go up to the front of the room and make a speech. I would check the leaderboard. I did this multiple times where I would check the leaderboard and I would make sure that I botched the last 2 holes to the point where I'm not going to actually win so that I don't have to make a speech. It was that bad. I was petrified. So I was playing this one tournament of champions. It was at a course called Highwood. You don't need to know this, but I got a 1-stroke lead on the last hole. And so I fired my drive kind of intentionally, left the face open, hit this big banana slice into the trees, thinking, okay, well, if I make bogey or double, I'll come second and it's all good. I think I'm 17 years old at this point. And the idiot that is playing with me makes a triple bogey and I ended up winning the tournament. So I get up there and I did my speech and I was soaking wet, absolutely drenched. I was so nervous. And I went up and I thanked the green superintendent for making the greens so smooth and did the usual thing. Thank you to the head professional. But I have no memory of it. Absolutely no memory. And when I sat down, it was amazing that I even made it back to my chair because I was so nervous. But the dude next to me, didn't know him very well, but I later learned to know him pretty well. He said to me, you might be a scratch golfer on the golf course, but you're probably a solid 12 handicap in your speech giving. And that was a huge compliment for me because, a 12 handicap, that's not good, not bad. It's kind of like, okay, it wasn't totally embarrassing. So after that, I started winning tournaments intentionally. Sort of back 9 of these tournaments, I'm planning my speech in my head just in case I win and I have to make the speech. It gets better and better. And then I've done it 50 times and then it was fine, right? I'm not good at it, but it was fine. After 50 tries, I won over 50 golf tournaments. You give a lot of speeches and you get better. So long way of saying, put yourself into uncomfortable positions as often as you can. Turn on a camera and speak, start a podcast, even if you're not ready, start videoing. You might not know this, but my live streams are live, but my videos are edited. So if you're really worried about this, start with something that you can edit. And then slowly over time, start doing things that are actually live. I don't remove anything on my YouTube channel. So my first live stream is still available. Just go to the bottom, just filter for oldest. First live stream, I will be talking about how terrified I was in that live stream. Even now, I'm getting better at it, but I'm fine now. But I'm still nervous. I would say you're just going to have to put yourself in uncomfortable positions and force it because I'm sure there are people in this world that are they just don't care what other people think about them and they don't care if they look stupid or if they embarrass themselves. I do. I don't know why I do. Genetic defect. I do. I care what people think, and I'm nervous. And but I have to do it. It's my job. So I want to be good at this. And so I just keep doing it, even though, you know how easy it is for me to just not do this? Believe me, I don't really want to, but people appreciate it and it's good for me. So, but I do appreciate the compliment because nobody really ever says that. And I certainly didn't think that about myself. So at least I've impressed one person. Okay. There is at least one other lurker on this chat that wants that as well. Somebody who wants to read my old emails. Okay. All right. I would love to trade signals from the emails for backtesting. Okay. Well, it's Monday night. I can't promise you I'll get it done by Friday, but you gave me a checklist of things to try. And I really did mean it. I am tech illiterate. Like it's 50-50. This is not going to work, but hopefully your instructions were clear. I'll give it a shot. If you think there's 3 people that want this, then I'll give it a try. If it's just one, probably not, but okay. Old emails it is. I think that's it. There was one question in here that, did I punt on it? I think I skipped it because it was part of the same thing. Yeah. Buying a straddle and then selling strangles is just going to be too capital inefficient. I'm sorry. I need more details before I give any definitive answer, but I don't like it. Okay, that's it. That's all the questions. What's the time? 16 minutes too long. I've never once succeeded in the 1 hour live stream. So give the video a like for me on your way out. I've also never had a live stream with over 200 likes. So that would be great if you could, on your way out the door, just hit that little like button. And who knows, maybe someday I'll get a live stream with more than 200 likes. All right, I'm coming back Friday because I am taking my wife to Paris. And so I'll probably pre-record some videos or something and upload them when I'm there. So it might look like I'm doing videos, but I'm not. But I do want to get one more live stream. So come back Friday. I've got one planned out, and then there'll be a 2-week break. All right, cool. See ya.